Hey everybody, this is Charlie Dobbins, and I want to welcome you to another group coaching call. This is live. If you're listening to it right now on GoToWebinar, it is live. If you have anyone has any questions, they can just type it into the question box, and I will respond right away. If you're listening to this in the group coaching archive section, it is not live, but you can shoot me an email at info@multifamilyinvestingacademy.com if you have any questions about what we're going to talk about today. I'm always going to start off with my disclaimer so you all understand it. I am a lawyer. I am not your lawyer. Get a lawyer, as required by the Bar Association of the Commonwealth of Massachusetts. Okay. Now, what we're going to be talking about today, there's going to be another 20-minute or so group coaching call. And if anybody needs to get a hold of me, if you're in the owner forum, you need to speak to me right away, just send me over a text. Make sure that you're on WhatsApp. WHATSAPP. Make sure you download that app to your smartphone, and then let me know that you're on board, and then I can add you to our group owner forum call, which is a lot of fun and it's a blast. I'm just going to fix my microphone here. It sounds like I'm picking up everybody. Okay, that might be a little bit better. All right. So what we're going to be talking about today is the power of the cap rate. Now, what I've done is I realize that a lot of students don't see me speak at different RIA clubs, at different groups that I speak in front of. A lot of you just met me over the internet, or you've heard about me or what have you. What I want to do is kind of give you a little bit of a snapshot of how I teach about multifamily. And this is just going to be on the power of the cap rate. It's not going to be into the discussion that I usually have in front of these groups as to why multifamily real estate investing it doesn't have anything to do with real estate. So that's another topic we can talk about at a different day. But I had a conversation with one of my students this morning, and she totally understood where I was coming from. And I realized that some of the other students might not really grasp the power of the cap rate and why it is so powerful and why it is so important that you understand this most basic concept of multifamily investing so that you can really get a vision as to how you need to run your business. And I'm going to do that by applying an actual story. Well, actual story is kind of made up, but when I apply these facts to it, I think you'll get a better understanding of what I'm talking about. What is the capitalization rate, or what we call the cap rate? Now, this is the textbook definition of what the cap rate is. It's a rate of return on a real estate investment property based on the expected income that the property will generate. Capitalization rate is used to estimate the investor's potential return on his investment. Now, understand the three most important words in this definition. Property based on the expected income. All right, it doesn't mean that it's the actual income. And also, the capitalization rate is used to estimate the investor's potential return. You see all these words in here that give you a lot of out power, a lot of gray area, because it's not an exact science. It's pretty darn close, but it's not always going to be exact. Nevertheless, as an investor, you need to know in that particular marketplace that you're looking at, on that type of investment, A, B, C, or D, what's the investment community using as a cap rate for that type of investment. So you take those places around New York City, Miami, all the big places. Good, solid real estate markets, you're going to see a very low cap rate. Risky areas, secondary markets, tertiary markets, you're going to see a much higher cap rate, a little bit more risk. All right, so there's a definition. Fine, who cares? Let's apply what this cap rate means to an investor. All right, so this is the formula. If you never thought you'd do algebra again, then you didn't think you were going to own multifamily property, because the cap rate, understanding the cap rate, it's all about algebra, okay? It's all about these three variables. And remember what you learned in algebra. What you learned in algebra was if you understand two of the variables, you can solve for the third. So if you don't know what the cap rate is, then you can take the actual net operating income and put it over the asking price, the purchase price, depending upon where you are in the process, and it'll determine what the cap rate is. Now, if you know what the cap rate is in a particular marketplace and you calculate out what the NOI is going to be, then you know what the purchase price should be for that property. See, this is the beautiful thing about multifamily, and this is why I got into multifamily, because there's no emotion involved. It's a formula. If the numbers work, you buy it. If the numbers don't work, you fix it. If you can't fix it, you move on. All right, so let's take a look at a couple of these things here. The cap rate is, as we said, determined by the market. So we need to know what that particular cap rate is to determine if the purchase price is a legitimate number. So make sure that when you're looking in a particular marketplace, you're going to know what the cap rate is for your property. Otherwise, you can be bamboozled every day of the week. They'll see you coming 1,000 miles away. So be smart about investing in the marketplace you're looking in. Now, the net operating income, we all know what this is all about. I mean, this is why we do the due diligence, is to make sure that the NOI is accurate, because we know that the brokers lie all the time. We know the brokers come up with these pro forma NOIs. And that pro forma NOI is created to justify the purchase price of the property, and because they'll tell you what the cap rate is, and they'll monkey around with the NOI so that they come up with the actual purchase price, the asking price of the property. It doesn't mean that the asking price is the true value of the property. It means they monkeyed around with the NOI. And it's your job to get in there and figure out the NOI, what is the right number. I mean, if this guy's showing you the NOI without any property management figures, well, that's not going to be the right number. And what that means is the purchase price is going to be overinflated. Well, you need to know that. You need to be able to go in and figure out what the NOI is. And then you come down to the purchase price, so your cap rate, the NOI, now the purchase price. Now the purchase price is the biggest lie, or the asking price, as I always say, is the biggest lie in multifamily. Don't believe it. It's what the seller would love to get his hands on if he could just find enough California investors to duke it out. All right, the asking price does not even compare to reality. But it's your job to know the cap rate and determine the NOI to figure out what the actual purchase price should be of the property. All right, so that's the formula. Now let's apply it. All right, let's put a face to the cap rate. Your deal, think about this for a second. If you're going out there to raise private money from grandma has everybody beating down her door in order to get her to invest with them. Now, grandma has to look at these investments and think, well, which one is right for me and my investment strategy? Now, typically, grandma is going to be looking at like a government bond, something safe and secure, something that'll give her long-term security. And as you can see here, these were actual numbers from one day that I pulled this off the Wall Street Journal. The actual bond rate for a government bond was offering 1.43%. That means grandma, after paying all the fees to all of the experts, the mutual fund guys, she is going she'll gross 1.43% on her government bond. That's it. Now take a look at this corporate bond. That's more of the middle of the road. And really, folks, the only graphic I could find on Google Pictures was of a General Motors corporate bond, and we all know what happened to that corporate bond. But typically, a good, solid, blue chip corporate bond is paying about 4.5%. And then remember the old junk bond days? I mean, when I first got out of college, junk bonds were in their heyday. I mean, they were paying 14%. They were paying some crazy numbers. That's what the market was bearing. And so right now, though, risky corporate bonds are trading at about 7.25. So grandma has these three choices: risky, safe, and government issued. So those are the types of returns that you are competing against in order to get grandma to invest her money with you in your multifamily deal. All right. Now let's take a look at what happens here. Let's look at these three properties. Look at the property on the left. This property on the left is at a 2.85% cap rate. Now, that 2.85% cap rate, why is that so low? Well, this happens to be a nice refurbished property in San Francisco, one of the hottest real estate markets in the country. And so this cap rate is now trading at 2.85%. Now, remember, I just said one of the safest, securest real estate markets in the country. Well, that type of investment will probably compare to the government bond. Remember, the government bond was paying like 1.4. Grandma can get 2.85 on her safe, secure Class A, well, not even Class A, but a nice multifamily property in San Francisco. So 2.85%, that's what you're going to have to show as your cap rate in order to compete against grandma's offer of the government bonds. Still risk involved, absolutely, but she's getting almost double return. Now the middle property is, and all of these properties happen to be in California. The middle property looks like a typical B-class property, just the kind of property I like. It's got a pitched roof, it's got individually metered, separate entrances, probably built in the 1980s. It's got hardy plank, it's got brick exterior, very easy to maintain, and it's a nice, probably built in the 80s, I said before. But this is a nice property. You'd want to own this property. You'd want to live in this property. And this cap rate on this property in California is 4.5. Now, a lot of you might be thinking, so wait a minute, I see a property like this in Texas all the time, and the cap rates in Texas are about 7 to 8% for this. Yeah, well, that's why I said you need to understand what the cap rate is in your particular marketplace. And in this particular marketplace in California, because it's a much safer, I say safer, but it's more of a hot real estate market. You're going to see a tightened cap rate market, and you're going to see it being about 4.5%. So now the B class property that competes against the blue chip corporate bonds is running at about 4.5%. And then finally, you look at this C class property on the right. That's the Oasis. I think it's in like Stockton or Compton, California, something like that. And that cap rate for that property is 6.6%. That's what those types of assets are trading for in that marketplace. So this is what your deal has to compete against. So this is why the cap rate is important for you to understand. But what you also have to understand is the cap rate, is a number that is used by the assessor's office. It's used by banks. If you don't know what the cap rate is in the marketplace that you're looking, then pick up the phone and call the assessor's office. That's a great place to start and say, hey, listen, I'm thinking about buying this property. What cap rate do you folks use to evaluate this property? Is it a 5? Is it a 6? And then whatever they give you, that number is almost gold, because that's what they're going to use to determine what the person's taxes are. If he can't give you the answer, call the local lender, call the local bank, because they buy REIS reports. They spend big money to get very substantial reports that's going to tell them exactly what the cap rates are in that particular marketplace. And they'll tell you, yep, we're looking at about a 6.6 cap for that type of property. And you're like, okay, thank you very much. So then you know what the cap rate is. And you know what the guy's asking price is, but we know that's a lie. So now we've got the cap rate. We need to figure out the net operating income. And once we know the net operating income, the assessor or the bank has given us the cap rate, we can determine what the actual value is of that property. So then the next problem in this whole equation is that the variable of the net operating income is what is being manipulated next. So let's figure out, just so you understand exactly why or how this NOI gets manipulated to the benefit of the current owner. All right? And hopefully we're going to change that and make it to the benefit of you. Let me just take a quick swig of my water, and also to find out if we have any questions. We have no questions. I must be explaining it wonderfully. All right, take a look at this guy. This guy has owned his apartment building for 20 years. He's paid off the debt. There's no debt on this property. But look at him. He's ready to move on. I mean, he's got the third wife now, and she doesn't like to go around and collect rents like he likes to do. and she just wants to go out and travel the world. So he's ready to sell this apartment building that he has owned and operated for 20 years. And he wants to leave the sale proceeds in a trust for little Johnny here, so that Johnny has some college money when it comes time for Johnny to go to school. And it's all coming from his grandfather, and it's all coming from his grandfather's wise investment of an apartment building 20 years before. But you see, the thing is here, this older gentleman has just one chance to maximize what he's spent the last 20 years owning. He's got to make sure that he can get as much money as he possibly can from this one property. And if he can, Johnny's going to be happy. But if he can't, all of that he did for 20 years, he's never going to get another chance to make that much money as he's going to on the sale of this property. So he sees you coming a mile away. Let's take a look at the cap rate. Remember this? Keep thinking about this number. This is going to make a lot of sense in just a moment. So last year, his net operating income was $100,000. And the cap rate for this type of asset in his marketplace is 10%. So I'm going to switch over to the question box and ask you folks, what's his asking price going to be? And I'll wait to see who's going to get the number right, who's going to get the answer right. Oh man, we have a lot of people on the call too. Who's come on, somebody there, somebody. What's the right number? Look at none of you. You're all hiding. All right, fine. Nobody wants to get it right or wrong. A couple of smart people on the call too. You guys should know the answer to this. All right, the right price, the right asking price is $1 million. Remember? Let's go back. If we take the net operating income of $100,000 and we have the cap rate of 10%, remember you just multiply, you solve for the purchase price, and it's $1 million. Okay, but the problem is that's unacceptable to this guy. He wants more. He's going to pay the broker commission. He's going to pay a few closing costs. He wants to net $1 million for little Johnny. So how can he manipulate this deal so that he can maximize his one opportunity to raise money? What if he increases his income by 10%? And what happens if he reduces his expenses by 10%? Now you might be thinking to yourself, wait a minute, Charlie, you can't just do that. You can't just say, oh, I'm making 10% more. Or you can't just cut the expenses by 10%. The expenses are going to be the expenses. Folks, this is how the game is played. And this guy is a savvy businessman. He knows how to do exactly these things. He knows how to increase the income by 10% over the next 3 months. Because that's all he has to show is 3 months. That's all your bank is going to want. And he can reduce his expenses by 10%. Let me tell you how. As far as increasing the income, he looks at his vacancy and realizes he's been running this property kind of, at about a 15% vacancy. So he tells his management company, fill up those vacancies. And the management company says, we've been trying for a year now. We can't make anything happen. And the guy says, remove all tenant criteria. Rent to sex offenders, rent to felons, I don't care. Just get them in there and get that occupancy up. And increase that occupancy and the gross collected rent by 10%. You see, he doesn't care anymore. He's trying to unload this property. It's not going to be his problem anymore that he just opened the doors to a group of sex offenders. It's going to destroy your business. Everyone's going to move out once they find out that your property is the haven for sex offenders. So, but he doesn't care, and you don't know to look. So he goes and increases his income by 10%. Now, how can he reduce his expenses by 10%? Very simply. It's very simple. All he has to do is stop paying his bills. If he reports his accounting on a cash basis, it'll just show that he hasn't paid out as much in expenses as he has in the past. What's he going to do? He's going to cut the pest contract. Oh, I don't care. Let the cockroaches, fill up, because I'm not going to own this property in the next 3 months, it's going to be somebody else's problem. But he is going to maximize his NOI by playing these simple games, all right? So what happens now if he increases his income by 10% and reduces his expenses by 10%? What does his asking price go up to? Let me see if anybody jumped on and gave me any answers. Yeah, okay. Gary did great. Hold on. Is that Gary or Gray? Hold on. I'm going to open up the block. Gary, good job, Gary. Okay, Gary. What happens if he increases the expenses by income by 10% and reduces the expenses by 10%? You know, he's just increased his NOI by yes, Gary got it right. It's 1.2 million. 1.2 million. All of a sudden, this guy changed the valuation of his property by $200,000 just by playing games with the NOI. And folks, who's paying that $200,000? Who is going to give little Johnny that extra $200,000 kiss in the mail? Who's going to do that? The answer is your children. And that's the way I look at all this stuff. It's always, everything is from my kids. Who's going to give Johnny that $200,000? Your kids. It's coming out of their pocket. They're the ones that's going to pay little Johnny that extra money, that extra kiss in the mail. And it's all because the old guy here knew how to bamboozle the income statement to your detriment, to his benefit. So that's why you've really got to understand, when you look at these properties, this is what these guys are doing to you. They have one chance to maximize their revenue, and they're going to take it as much as they possibly can. Just by changing the tenant criteria and stopping paying his bills, he's just gone up by $200,000 in valuation. $200,000. That's the power of the cap rate. Isn't that amazing? He just increased his balance sheet, his assets, by $200,000. What happened to your kids? They just took on a loan for $200,000 that they now have to pay back. You don't want to do that to your kids. So understand the power of the cap rate, all right? So little Johnny gets another $200,000 kiss in the mail. And that is what we protect against, and that's what we do to make sure that, at least I make sure my students don't get caught in this and overpay for the property, because it's exactly what you're doing. You're overpaying for the property. Don't get emotional. It's just a formula. Just do it. As always, anybody on this call, if you need any help from me, just let me know. That's what I'm here to tell you. And that's it. That's the power of the cap rate. So that's your lesson today. And here's one of the reasons. And let me just put and if anybody has any questions, because believe it or not, this is going to be another short group coaching call right before the long weekend. One of the things that you need to understand, and I hear this so many times from new investors, they'll say something like, oh, well, these guys are able to run the property themselves, so they're not charging the property any management fee. Isn't that great? That's why we're able to show that this property is worth so much more. And I put my head in my hands. I do the old face palm plant, and I think, you've got to be kidding me. Do you honestly think that's a benefit to the property? It isn't, because you are going to run this property with a management fee. And when you put the management fee, that means your NOI goes down by that amount. That means the value of your property will go down by that amount times the cap rate. Okay? So you need to understand what it means to leave out certain expenses in the seller's analysis, and how it can impact you. But think about it from a conceptual standpoint. The guy is saying, the management fee typically would be about $10,000, but I do it myself, and I don't pay myself that $10,000. So that's why the property is worth as much as it is, and you can do the same thing. Okay, think about that for a second. If the cap rate is 10%, and this guy just reduced his expenses by $10,000, how much in value did the property increase because he didn't include that line item expense. 10% cap rate, $10,000 expense. Gary's going to give me the answer. I know it. Somebody give me the answer. Exactly, Gary. He just increased the value of that property by $100,000 because he wasn't paying himself a $10,000 management fee. So, do you get it now? The guy decides, okay, this year I'm not going to pay myself a management fee. I've been paying myself every year up to this point, but this year I'm not going to pay myself a management fee, and I'm going to drive up my NOI by $10,000. And then when he goes to sell it at a 10 cap, the property is now worth $100,000 more. Would you do that deal if you owned it? You'd do it every day of the week. You'd forego your $10,000 in income so that some sucker buyer is going to come along and pay you $100,000 more. Give up $10,000 here for $100,000 there? Absolutely. Why wouldn't I do that? And so when I explain this to the new investors that way, it's like sunrise over Marblehead. They get it. They realize, holy cow, that guy just, saved himself $10,000, but it means that I end up paying $100,000, or my kids end up paying $100,000 down the pike. And that's exactly what you want to protect against. You don't want to have that happen. And that's why you need to understand exactly the games that these sellers play, so that it doesn't impact you, right? All right, everybody. Hey, good answers. Thanks, Gary. I appreciate it. Gary gets the Student of the Week award. And if anybody has any other questions, remember you can just shoot me an email at info@multifamilyinvestingacademy.com, and I will have this particular lesson up on the recording, up in the group coaching archives, probably before the end of today, so you can get it. I'll shoot out an email to all the members that you can go listen to it, and also for those members who are owner forum members, I'll send out a notice on WhatsApp. So, all right, if there are no more questions, I will shut it down and wish everybody a great long weekend. Have a lot of fun. Get yourself ready. You got about another 4 months to go in the year to get your first deal under contract, and that's what I'm here to help you with. So let's do this. All right, everybody, have a great time. I'll talk to you soon.